Hi there traders, and welcome to the latest video blog. Apologies that there hasn't been one for a while. Just been getting involved with a few new projects, so it's taken me away from the blog, so apologies about that, but I hope it finds you well and trading's been going well. Today we're going to concentrate on the topic of mastering Fibonacci, mainly because quite a few of you have been asking for a little bit more information on it, because you've heard about it, you've tried applying it, but not quite 100% on it. So we're going to go for a short presentation today, just identifying how to use it correctly and how to take advantage of it, because it is personally one of my favorite tools. The reasons for that we'll go through in due course, but more importantly I want to get you away with the ability to go and practice it on your own charts, master it, and then really use it to your advantage. So let's go through the presentation. I've done a few slides because it's a little bit easier to illustrate the Fibonacci tool with the slides and then to show you on the chart afterwards. So I've got a few slides that we're going to go through first. So Fibonacci, in first and foremost, is what is it and why can we use it to our advantage? Firstly, it's a tool to help measure the opposite or phase 2 component of a strong trend, so that move against the trend that we know as traders we want to be looking forward to, because as point 2 says here, it helps us to ensure an efficient entry into the market or a better price into the trend. So trends are obviously fantastic because they confirm the overall direction, but the last thing we want to be doing is jumping in when the train is moving 100 miles per hour or the horse has already bolted. When the market is right at the top of its uptrend or right at the bottom of its downtrend, we're simply not getting a very efficient entry into the market. So the Fibonacci tool is there to help us to wait patiently for the market to retrace and give us a better price to enter the market. If it's an uptrend, it's a cheaper price to buy at. If it's a downtrend, it's a more expensive price to sell at. And Fibonacci, again, like most things in trading, again, it's not the holy grail. It won't just all of a sudden cause you to win on, to make profit on every single trade. Of course not. It's there to be used in confluence or conjunction with other technical factors and fundamental drivers. One of the main things you need to have when using Fibonacci is you need to have a clearly defined trend, because without the trend we can't see where the retracements lie. And also it's really important to have in that trend really clean cycles, so you can see highs and lows, because those highs and lows are going to be massively important to us in terms of where we draw our Fibonacci from, and two, to give us those all important retracements. So not only is a trend essential, an uptrend or a downtrend, it's important that within that trend we have clear cyclicity, phase 1s and phase 2s, big moves up, big moves down, so we can see those cycles and use the Fibonacci tool to the best of our ability. Sometimes we get trends where it's really hard to identify clean cycles. That's where the Fibonacci doesn't become that useful to us. Also, trying to apply Fibonacci when there's no trend at all, again, is pointless. So it's really important that we have a clearly defined trend, and within that trend, clean cycles. And we'll have a look at a couple of examples in due course. So that's what it is, and that's why we use it, is to get the most efficient entry into the market, the best price possible into the market. So let's have a look at the two market conditions, both the uptrend and the downtrend. So in an uptrend, we have these big moves up, what we call the phase 1, the longest and the strongest phase of the cycle with the trend, and then the market move against it is what we call phase 2, this move here. So with drawing the Fibonacci in uptrend, we need to see the market come off its highs and start to move back down. When that happens, we can identify point A, which is the start of the most recent swing low, to point B, which is the end of the phase 1 and what we call the recent swing high. So that would be our A point, and this would be our B point. The market is now pulling back or retracing, so now we can start to apply our Fibonacci retracement, because as the market pulls back, it gives us a much more efficient entry into the market. Now A to B, see that as 100%. So this move from A to B, from the start of phase 1 to the end of phase 1, is what we call 100%. And then we want the market in phase 2 to pull back a certain percentage of this move. We obviously don't want it to pull back 100%. We want it to create a higher low, so we want it to actually pull back a small percentage of this major move up. So the ideal zone is, or the most common zone, is anywhere between the 38% and the 61.8%. So obviously the 38% is quite a shallow retracement, whilst the 61.8 is a much deeper retracement. Now, I don't really have a preference in terms of the numbers that I use, or a favourite in terms of the Fibonacci level I prefer. I just treat it as a zone where I want to see the market pull back into, and then I'm going to look for other confluences or other clues that suggest the market wants to move higher. So anywhere between the 38% and the 61.8 is an ideal zone. As we see here, they're horizontal levels. So when we draw our Fibonacci from A to B, it will project these horizontal levels into the future. And when the market drops into this zone, almost like a little trap, I want to see other factors that suggest that buyers are coming back into the market. Things like bullish price action or horizontal levels of support or trend lines or moving averages. All these things that suggest that this area here could be a very, very key turning point and the next leg is likely to be higher. When we find those elements, that's when we can look to apply our strategy and look to get the most efficient entry into the market as the market pivots and starts to head back up. As we see on this slide here, what we're expecting in a strong uptrend is this temporary move back down to finish, and then phase one, the phase that is with the overall trend to kick in, and that's where we're looking to get into the market, because if we can get in to a phase one as early as possible, the probability of making a decent return on it is very, very high. So this is the area, the Fibonacci zone, that we want to see the market react to. Buyers come back in, show their hand, and then the market to head higher. This is where you'll be looking to apply your strategy to try and get into the market as efficiently as possible. And this can be applied to any time frame. Obviously, the higher the time frame, such as the daily, the 4 hour, the hourly, are more technical, whilst the lower the time frame you go down, anything lower than the 15-minute chart, it becomes a little bit noisier. But the concept can be applied to all time frames and to all asset classes. And we're looking to enter here at the turning point where the market rallies higher. In regards to the downtrend, like most things in trading, it's the complete opposite. In a downtrend, we're looking at lower highs and lower lows, with the big move down here from A to B being what we call phase one with the trend, whilst point B to where we are now is what we call phase two, which is the contra trend move, this move up. So it's temporary buying in a major downtrend. So we expect that to happen as people take profit here and the market temporarily comes back up, and it's here that we want to see an efficient entry into the market, getting back in the tide with the sellers. So we would measure from the recent swing high, which is illustrated from point A, to the recent swing low, point B, and it's the most obvious. Again, appreciate that some cycles in trends are very subtle, but look for the most obvious major peaks, swing highs, and the major lows, just here, swing lows, to mark your B points. So once we identify those, point A and point B, the most obvious swing high and the most obvious swing low, we can draw our Fibonacci on, and it will measure this retracement, this phase two, to tell us what is a normal retracement, to ensure that we are getting the most efficient entry into the market. So we wait for the market to pull back up and then react with the sellers. So anywhere, if we treat A to B as 100%, again like we saw with the uptrend, A to B is what we call 100%. That's the phase one, full move. We want to see the market pull back anywhere between 38% and the 61.8%, because that's seen as a normal, conventional retracement. Anything further than 100%, we start to get concerned, because why? Well, the market is starting to create new highs, which in a downtrend is a massive concern. It's saying that actually buyers are becoming stronger than what we'd like to see. What we want to see here is a retracement between the 38% and the 61.8%, because that will effectively cause the next lower high or swing high before phase one kicks back in and the market moves lower. So as we've said, anywhere between the 38% and the 61.8% is the ideal zone, but make sure that we're combining that with other factors. So as we see here, these red lines confirm where that trap is, where that zone is. 38% is a very shallow retracement. 61.8% is a very deep retracement, but anywhere in here we want to see the market react and sellers start to come back into the market. If we can combine this with other selling clues or other selling technical factors, such as horizontal levels of resistance, trend lines providing resistance, moving averages providing resistance, and potentially bearish price action confirming that sellers are moving back into the market. So you want to find lots and lots of clues here. It's what I call getting confidence from a confluence of factors. So the more things we can find in this zone, the better. But the one thing that the Fibonacci retracement tool does is it confirms that we're getting an efficient entry into the market, a more expensive price to sell at, whilst with the uptrend it was a cheaper price to buy at. So once it gets in there, combine it with other factors, and then we're looking to ideally get into the market as it turns from this temporary phase 2 back into this very strong aggressive phase 1, which is with the trend. And trading with the trend has a higher probability of success than trading against it. So if we can get into the market as early as possible where phase 1 kicks in, our probability of making a profit on this is much, much higher. But the key element here is that you're getting a much more efficient entry into the market. You're not trying to sell at the lows or with the uptrend, buy at the highs. We're waiting for the market to pull back, which it will do eventually. Sometimes we have to be very, very patient. Put your Fibonacci on and make sure that it comes into this trap, because then you can take advantage of the next big move down in a downtrend. So that is very brief in terms of explaining what it is. It's a very simple concept, but it's very, very hard to apply in real terms. But hopefully that gives you an idea of where you need to draw it from and to, and more importantly, the concept that underlines it. Why do we use Fibonacci? Well, it's ensuring that we're getting a better price into the market, both in an uptrend and a downtrend. So let's have a look at some market conditions. I'm just going to jump onto a chart where we got a very, very nice downtrend. So from top left to bottom right, we're getting lower highs and lower lows continuously. The reason why I've identified this chart is we have really clear and really obvious cycles. So these swing highs and these swing lows, we know how important they are, because without them we can't find our A point and we can't find our B point, and without that Fibonacci is of no use to us whatsoever. It's also nice because we've got a really nice bearish channel, so we've got strong resistance at the top of this trend line, and we've got strong support off this trend line at the bottom. Obviously the one that's more important to us is the one at the top, because we'd be looking to sell in a downtrend, trading with the trend. So I'm just going to put a few on just to show you how we draw them on. I'm going to go for the most obvious swing highs and swing lows. So remember, a downtrend, we're always going from the start of the most recent swing high to the end of the swing low. So if we found this one here, we'd go from the top, which would be our A point, and I'll pop it on there, and then I'll bring it down to my B point, which would be at this swing low just here. And as we can see, the market rallies into this zone, and we get this lovely reaction, this bearish price action just here, which is a reversal candle where the market reacts to the 61.8 and the market pushes back down. It then does push a bit higher into this resistance level, but we definitely got a reaction there that we could have potentially traded for a few pips. So I'm going to take that off now and just show you another one. So let's have a look at this one here, where it pushes all the way back up into resistance and then starts to head down. So I draw from my A point, which is the recent swing high, start there, drag all the way down to the bottom, swing low. As we see, pushes all the way into our trap. We get the reaction of very, very bearish reversal candle, such as a high test candle, against a strong trend line, which has been reacted and respected many times before, and then the market heads down stronger. So rather than trying to sell at the bottom here, it ensured we waited patiently for it to come back up, hit its head against the ceiling or a resistance, and also making sure that it retraced at least 38%, but this one was a much deeper retracement, and then we got that reversal signal that was the initiator of the next big phase 1 to the downside. So again, I'll take this off just to remove it and draw another one on, because we get this lovely cycle. So from here, again, this swing high, which is point A, start, bring it down to point B, which would be down here. And as we see, the market rallies. We get this lovely rejection candle as the sellers start to show up in the market, and the market thrusts back down as we get that pivot from a phase 2 back into phase 1. And again, plenty of pips to be had in this particular example. So the key element here is making sure that you've got a clear trend. Also making sure that you've got clear cycles, because without the cycles you can't draw the Fibonacci. But when you can, use the Fibonacci to advantage. It's ensuring that you're getting efficient entries into the market, but make sure you're not just using Fibonacci on its own. Combine it with other factors such as resistance levels, such as bearish price action in the downtrend, etc., because then you can have a powerful team for trading that's not just reliant on one technical clue, it's reliant on several. So that's a nice example of a downtrend. Let's also have a look at an uptrend where we're just switching it over. So I'm going to have a look at the dollar CAD, because we've had a beautiful uptrend recently with nice clean cycles, a bit similar to the previous one that we looked at, but now looking at an uptrend channel where we've got lovely support along the bottom and lovely resistance up at the top. And again, it's really, really important to identify clear cycles, and I can see clear moves up, clear moves down, clear moves up, clear moves down, so I can identify swing highs and swing lows on a regular basis, so I can then use my Fibonacci to my advantage. So again here, we can have a look at this big move up, and then it pulls back down. So I want to see how much has this retraced, this phase 2, how much has this retraced in regards to the big phase 1. So remember, we're flipping them over. The A point is at the bottom. Start there and we drag it up to the B point, which is the swing high, and that shows us that the market has retraced all the way back down to support. It's hit the trend line, it's hit the moving average, but it's also retraced 61.8%. Then we get a very bullish price action signal and the market starts to really rally strongly to the upside. So again, very, very efficient entry into the market if we're applying our strategy down here, buying off strong levels of support, making sure that we've got the cleanest or the most efficient entry into the market, which the Fibonacci helps us guarantee. Again, let's use this one here. We see a big move up, then the market retraces. So let's measure this retracement. Again, it hits support, hits our moving average, hits our trend line. So let's see if it's retraced. So from swing low, point A, to swing high, point B. Again, it's gone a little bit deeper than the 61.8, but again, a nice bullish reaction, and the market really pushes higher off support as the market rallies from phase 2, temporary retracement, back into phase 1. And again, we finally see it here, from the bottom here, all the way to the top, from A to B, and the market comes all the way down, and we get this lovely inside candle, and the market pushes firmly higher. What does it also hit? It hits my trend line, support, and it also hits my 50 daily moving average. Again, a strong layer of support. So not only do we get an efficient entry because it's come back down to the 61.8, we're also buying off strong key levels of support which have been respected many times in the past. So looking at it now, it looks very, very interesting because we created this brand new high. So I can put my Fibonacci on and be proactive as possible. So I'm going to go from A point to B point, and I can see that the market hasn't started to pull back yet, but if it does, next week we'll want to see the market pull back into this zone around about down to the 1.1400, big round number, big number that big institutions will trade off, and I'll be looking for a potential entry down here as it comes back down and hits trendline support and moving average support, but more importantly ensuring that I get the most efficient entry into the market. However, I need to make sure that phase 2 starts next week, because if it carries on going higher, I'll have to adjust my Fibonacci to make sure I get the swing high point correct. But hopefully the presentation that you've just seen will ensure that you get that right, and after applying it several times you'll become very, very good at it. I remember when I first started using Fibonacci I was getting it the wrong way round, but just by watching the video back you can know where to draw it from and to your A points and your B points, both in an uptrend and a downtrend. But remember, clear cycles is the key element, because without them you can't identify your A point and your B point, and then that obviously eradicates the power of Fibonacci. So it was very short, sharp, to the point, but I hope it's helped, especially those of you that were requesting I did a little video on them. So hopefully now you can go away and really become a master of applying Fibonacci, because it's a very, very powerful tool. A lot of the big institutions use it, so we know that when the market reacts to these key levels, they're going to react very, very strongly, because just as much as when we go to the sales, like a Boxing Day, big institutional traders will have to do the same thing. They will need to justify to their bosses that they've got the most efficient entry into the market, of which the Fibonacci tool can be one tool that they will use to justify a very efficient entry into the market. So if we know the institutions are using it, it's going to be very, very powerful reactions off those levels in combination with other things. Remember, the Fibonacci on its own is powerful, but put it with several other factors to make sure that you're getting the most efficient entry into the market. So getting the direction right is half the battle. Getting the timing correct is the second part of the battle, and probably the most complex. Timing into a market is very, very tricky. As we can see, dollar CAD has been heading up for months and months and months, but getting in at the right time is the tricky bit. So the Fibonacci can help us with the timing into the market. Okay, so I'm going to wrap up there. I'm not sure whether I'm going to be able to do any more videos before the Christmas break, so I'm going to take this opportunity to wish you a very Merry Christmas and a prosperous New Year for 2015. I'll be back doing video blogs most certainly in the new year, but I may have some time to get another one pushed in just before Christmas. So again, as always, please feel free to email in with any questions or any comments. But if I don't speak to you before, have a great festive period, and I'll speak to you in due course. All the best.